So, so here, and I think we can have some consensus here on how we get ahead. But one area that I think this committee should examine is the current state regulatory frameworks. Did the working group consult with state regulators on their existing frameworks?
Yes, yes, the working group did consult and talk to state regulators, and a number of state regulators have increased their expertise in this area.
But
The PWG report believes that a more consistent, less fragmented framework is preferred.
and does that also mean that the president's working group would think that we shouldn't have state chartered credit unions or banks? By that same notion, that would be like saying we only have federal banks. So to that point, you consulted with these regulators, but there was no mention of the existing state regulatory framework. Why was that? Why did the president's working group make that decision to not mention existing existing frameworks and lessons learned from those existing, state frameworks?
Mm-hmm. The working group proposed a consistent framework.
I understand what you proposed.
The state regulators. So a proposal for an IDI could be a state chartered or a federal chartered bank.
But what I'm asking is a separate question, Undersecretary. Look,
Yes.
it's not an adversarial conversation. I think the fact that the administration's put out this report is a welcome thing, and you've given one solution to a really complex set of industries. But there was no mention of any state regulatory framework. We know that New York is the most active, and they have a very safe but very robust set of regulation and disclosures. But there's no mention of New York. There's no lessons learned from the states included in this report. I was interested in why that was, not the question of what you reported. I've read the report. So why not understand the lessons learned from the states, and why was that not included in the report?
Right. There's no explicit reason for why it was not included. It was certainly considered as an alternative. The principal reason is that the state regulatory system is fragmented. There is an issuer, and then there are the custodial wallet providers, the other parts of the arrangement that are subject to different kinds of regulations.
Okay, so
there is no plenary oversight of the entire arrangement.
Thank you. I appreciate your response. By that same notion, you would like to have a single regulator at the federal level for all financial institutions. That didn't succeed in Dodd-Frank. Now, I do want to ask about de-risking, though. In the report, you outlined that these are risky. This is an extremely risky proposition of stablecoins. But the conclusion here is that you should put them in a federally insured depository institution. With Dodd-Frank, we attempted to de-risk those institutions. And what you're adding to explicitly with this report is a riskier aspect that would have a federal backstop and the federal taxpayer backstop and the unwinding authority granted under Dodd-Frank for these institutions, and specifically this product. Shouldn't we be in the game of de-risking rather than adding to the risk of a federal bailout, or for these products?
So I think in the current environment, regulators are in a bit of an uncomfortable position. Stablecoins are increasing. They've grown rapidly, as you've said. There are risks. Regulation is about where those risks should reside and how to protect users and investors. And if stablecoins are backed by high quality assets, their risk is quite low. And they can form a building block a cornerstone of a payment system. But if
Thank
they're not supported and there's questions about the quality of the assets in the reserve pool backing them, then they create risk.
Thank you, Madam Chair. I appreciate the extended time we both got to share on this. I
Yes.
do think the state regulatory framework we can learn a lot from of what they've done well and the things that we can do better.
Thank you,
And I
Mr.
appreciate the
McKinley.
engagement and yield back the balance of my time.
Thank you. The gentleman
in the United States. And so I'm concerned if we continue down a path of ill-fitted regulatory constructs, we may be moving this innovation offshore rather than coming with the approach of how can we help? How can we help bring innovation here into the United States? And so with that background, Undersecretary Liang, we've had a great conversation today about digital asset firms, how they're currently in particular state regulated. And so besides the money transmitter regimes, as we've noted today, several states have developed pretty sophisticated approaches to digital assets regulation. As we noted in New York, the BIT license allows firms to apply for limited purpose trust charters under state laws. But I've noticed in many ways your report didn't really address the regulatory framework in states. And so earlier, I think you mentioned that you talked to state regulators and analyzed state frameworks. Is that correct?
We did consider state frameworks yes, we considered state frameworks.
But there's not really an actual analysis of state frameworks included in your report. Is that correct?
No, we did not include discussion of state framework analysis.
And so do state chartered depository institutions have a primary federal regulator? And are they subject to federal banking regulations?
I think federal banking regulations can apply to banks that are state chartered.
Okay,
some of the BIT licenses are, as you said, limited purpose banks or charter banks, as I understand them, or trust banks.
Yeah. I appreciate that. So I'd like to go back a little bit in time here earlier in the hearing, back to a response you gave to my colleague, Mr. Loudermilk's question on the PWG approach. I think you referenced, if I recall correctly, you said it builds upon existing state laws. But as we just noted, the report doesn't really analyze state laws. There's definitely a federal primary approach. What do you mean by builds upon state laws?
Yeah. So one is currently all stablecoin issuers and custodial wallet providers are subject to our money service businesses and money transmitter laws apply to them. That is at least 49 state regimes. The proposal does not replace the state money transmitter with a federal money transmitter proposal, which I understand maybe some legislators are considering, but it could build on that and require a set of risk management standards that could apply to custodial wallet providers. In that sense, it builds on the state frameworks. Also, insured depository institutions they can be state chartered or federal chartered. That's in the current system. But even a state chartered bank has always had some federal layer on it for deposit insurance or some of the other features of a traditional bank.
Yeah, I just think it's a really interesting topic here, so I'm just trying to flush it out a little bit. So if we look at kind of a construct that would privilege federally insured depository institutions, how would you account for the existing state-based regimes that already apply to incumbent firms? It's a little bit what you're talking to, but kind of, could you hit that point for us?
Yeah, so I think that would be something that would be that needs further discussion. The current existing state charters, at least some of them, do not provide the supervisors of those institutions a sufficient visibility into the broader payment arrangement. And so that's where we're looking to fill that gap.
Yeah, understood. So Undersecretary Liang, I appreciate your time. I think it's just really important that we get this right. I think we're digging into the right topics. I think the key here is to make sure that we don't overregulate, that we encourage innovation, in the United States of America. I think we're at a moment in time where there's great opportunity. We don't want to overregulate this and throw the baby out with the bathwater on what is clearly a really interesting space of development. And so cognizant of the time
at this point in the US.
I
And
can tell you the CEOs that came before us, really, the regulatory structures that they set up and were working with, especially under at the state level, met these high level recommendations and addressed a numbers of these risks that were highlighted in the report. Do you agree?
We have talked to some of the states and have talked to supervisors, and I believe while they believe under some of the licenses, they have oversight of the issuers and a different look through a different lens at the wallet providers and the other kinds of entities that are involved in storing, transferring, allowing stablecoins to be used as payments. That's a different set of regulations under the money transmitters licenses. And there is not plenary oversight of the overall arrangement. And if stablecoins are going to be used widely as a payments mechanism, there is a concern of trying to make sure that they can actually perform their function, that there's operational oversight of operations for cyber convertible.
Let me just say this. It seems that we should be examining the best practices under state frameworks instead of pretending that they do not exist. Applying a uniform regulatory framework to stablecoin issuers will discourage innovation and push stablecoin activity and jobs out of the United States. We must, I think, ensure that any federal regulatory framework provides clarity and also ensures that the regulation fits the activity rather than simply overlaying traditional banking regulation over stablecoins. Undersecretary Liang, in your opinion, how can
operational risks as well?
So let's talk about that. So this is where it gets to money markets.
Yes.
And we broke the buck. The reserve, whatever
Twice.
It was, twice we broke the buck. And Ms. Wagner and Mr. McHenry were sort of saying, well, why are we trying to, make this a federal issue? Well, let's just go state by state. Well, we saw with money markets, even though we didn't back them, because so many people used them as currency or as a payment medium, we ended up backing them.
Right.
So the question is, do we want to do this before something goes to heck or after it goes to heck? I mean, that seems to be the question to me.
Right. The PWG report would suggest before.
All right. Well, I think this is a great education on sort of an economic system and the payment system. And I wish you very good luck in trying to come up with a good answer. Thank you.
Thank you very much.
Thank you very much. The gentleman
or the service.
Yeah, I agree with that. Just my time short. I'm an activities-based person as opposed to jamming everything through entity regulation, particularly in an innovation, which is the jury's out for me on whether these have to be issued by a depository institution, for example. I don't think you're wrong to suggest that. But would you support a federal money transmission license or a national payment provider license that would be a national license similar to what we see in the EU? Is that an alternative that you would accept?
I think that is a possibility definitely worth exploring. The US does not have a federal money transmitter license, and so we did not build on that framework.
Yeah. Well, and that gets into this issue Mr. McHenry asked about state regulation. Are you supportive of states going ahead and defining some of these quality standards around stablecoins as we've seen in the instance of New York?
I think in the current environment with stablecoins already in play and growing rapidly, the current regulators need to do need to take actions to meet their mandates. As I understand it, some state money transmitter licenses don't even apply to digital assets. So it feels like there's probably room for different states to be revisiting their rules.
Yeah, thanks. And on the subject of deposit insurance, I agreed with a lot of the comments that I don't really think that's the right road to go down for these assets. I think defining them is a much better approach, whether they're used as a transaction payment activity or as an investment holding activity, and that we just use activity-based regulation based on the definition. As to whether or not they're systemically important, that seems a stretch for me at 150 billion or 170 billion. When you think about, we have 5 trillion in credit card transactions a year, and we have almost 5 trillion in money market funds. So to me, I thought that was a stretch. I encourage my colleagues to let's work together on a narrowly crafted definitions bill for what's a good stable coin. Thank you for your time, and I yield back.
Thank you very much, Mr. Hill. And
innovation and technology and not try to stifle it. The report also doesn't address the regulatory frameworks that many states have already established for digital assets. Banking regulators in a number of states supervise stablecoin issuers under money transmittal laws. A question, Ms. Liang. The report calls for Congress to establish a federal regulatory structure for stablecoins. As part of that, does the administration intend to account for the regulatory frameworks that many states have already established for digital assets to avoid creating redundant requirements?
So the PWG report recommends a framework that reduces inconsistency and reduces the fragmentation of current regulations and builds on the state current framework. It can build on the state money transmitter laws. Insured depository institutions can be federally chartered or state chartered. The goal of the framework was to provide some consistency, which we believe actually is beneficial to innovation. That having state laws apply, which vary and increase the complexity of addressing lots of different regulations, is a hindrance to innovation.
So what you're looking at doing, if to make sure I understand this, is considering state laws, but you want to avoid having contradictory state laws. Is that to where that one state may have one regulation, another regulation? Or are you looking at what I'm understanding you're saying is you are considering existing state regulations?
Yes, it would build on existing state frameworks. As I mentioned, insured depository institutions can be state chartered or federally chartered. State money transmitter laws, as the one mentioned, they're at the state level. There is no federal money transmitter license. So this was an approach to try to reduce some of the fragmentation in the system with an approach that we believe can be flexible and does not use the entire set of rules that apply to traditional banks, and they could be adapted to stablecoin issuers.
Well, I think that is important, not have fragmentation or conflicting regulations, but also I think it's important to avoid one size fits all regulations specifically. We should not be broadly applying banking regulations to stablecoins. So does the administration intend to account for the significant differences between depository institutions and stablecoin issuers in its regulatory approach? Am I understanding that?
Yes, that is our understanding, that the banking regulators have flexibility to adjust the supervision and regulation that would account for differences between stablecoin issuers and banks that also make loans. So it would be a different approach.
Thank you. And Madam Chair, I yield back the balance of my time.
thank you very much. The gentleman.
this particular hearing as well. Undersecretary Liang, I'm just curious. In South Dakota, we have a number of different licensed crypto custodians. They've been licensed through the state of South Dakota and in some cases federally. Just to give you an example, we have Anchorage. This company received their charter from South Dakota Division of Banking in July of 2019. Anchorage Trust Company received its OCC charter in early 2021, becoming the first federally chartered digital asset bank in history. Now, although a bank, it does not offer deposit or lending services. BitGo. In September of 2018, BitGo was approved by the South Dakota Division of Banking to act as a qualified custodian for digital assets and created the BitGo Trust Company. Kingdom Trust. Kingdom Trust serves as an independent qualified custodian for the assets of clients of registered investment advisors, broker-dealers, and investment sponsors, as well as their individual retirement accounts, non-qualified plans, and qualified defined contribution 401k plans. Kingdom Trust Platform was the first to allow self-directed retirement accounts holding digital currency investments directly. Now, in each of these cases, these are custodians. They do not issue a stable coin, but they act as a custodian for digital assets. Stablecoins, as you indicated, were just a small part of what could be used out there in terms of different cryptos or cryptocurrencies. I'm just curious. I think that stablecoins definitely have a future, and I am concerned that if we do not put in appropriate but measured regulatory a system in place here, that we may very well fall behind other nations that do. If we want to continue to be the reserve currency of choice, I think we have to allow options for very efficient ways in which to make payments. I think stablecoins can fit into that. If they are a viable payment mechanism, then it means that a regulatory environment that promotes that. And just the fact that all of these have occurred in just the last few years means that there's probably a lot more innovation to come in the future. And we most certainly don't want that innovation to be unnecessarily stymied by a one-size-fits-all regulatory environment here in the United States. In looking at the report in its entirety, where do you believe that the regulatory framework should exist after reviewing it? Where should it exist within the federal government?
Mm-hmm. So the PWG report came down on the view that a consistent, less fragmented regulatory framework is preferable to one that is inconsistent, that less fragmentation will spur innovation more than a very fragmented system. When we reached out, when developing the report, we were hearing from firms, developers, that they would like more regulatory clarity. Currently, states do issue charters. They are learning a lot from this experience, but they do differ across states. State money transmitter licenses are across 49 different states. They vary quite a bit in terms of what they cover. They usually address consumer protection, but they are not designed for modern payment systems. So the PWG came out on the side of a less fragmented, more consistent, more comprehensive framework.
My time has expired. Thank you, Mr. Chairman.
The President's Working Group report has interpreted integrating states' rights and states' regulatory authorities in the grand scheme of things. I've approved of the innovation that occurs at a state level, and I'd be very interested in your view on how you would intend to incorporate state perspectives, or is this going to be a heavy-handed one-size-fits-all approach?
So I think the recommendations of the PWG report are building on the state frameworks that currently exist. The first recommendation that stablecoin issuers be an IDI, an insured depository institution, given the flexibility within that framework, is still that the IDI can be a state or federal charter. Second, it is building on the state money transmitter licenses. Was not a recommendation to replace. I do think some of the state money transmitter licenses requirements probably need to be updated for digital assets, for example, and they were not designed for the kind of new emerging modern payment system. But it would, the recommendation is that you be able to require some higher risk management standards, but not to replace the existing framework.
I appreciate your desire not to replace it. I hail from Tennessee. We have a wonderful state system there, and I think one that's agile and capable of incorporating recommendations, but at the same time solving in an agile way for new innovation. So I encourage that you continue to incorporate the state's perspective. I'd also like to touch on another